Okay, everyone, this is my video, the fourth video in my series called the Dow Gold Theory videos. And this one is called, let me get this thing going here, play from start. Uh, Bank versus gold versus Huey index versus individual mining stocks. I want to compare the returns on those investment vehicles. And then, first, I'm going to do a quick recap of the videos 1 through 3. The video I'm on right now is video 4, and in the first video, I talked about the Dow Gold ratio chart schematic, and in the second video, I calculated a high value uh, for the price of gold. And then in the third video, I calculated the date when that high value would occur. And I realized, of course, they're not going to happen exactly on that date, but the calculations just lend to a specific number and a specific date. And the whole idea for me is to get comfortable with where I think gold is going to, and therefore make better investment decisions. And part of that is making these videos and collecting my thoughts and thinking clearly. I think the videos help me with that. And if they help somebody else, that's, icing on the cake. I hope they do. If anybody has any questions, of course, you can put them in the comments down below. I don't think videos like these get a lot of views because they're on economics, but I guess this is considered economics, but investment ideas. And these are my own ideas for investment, and I'm not trying to give any investment advice either. So here is the first. Go watch the first video if you haven't watched it, but basically, I take the Dow Gold ratio in chart, and I came up with I saw this pattern on the chart, and I made a schematic of it because it's easier to see the pattern in a schematic. And the chart was from macro trends, and basically, it's simply when it's better to be in. It is phenomenally better to be in stocks when this thing is going up, and then switch to gold or gold mining when the thing's going down, rather than being, a gold bull straight through, or, a stock bull straight through. Switching at these predictable intervals really, really increases your earnings. And there's the actual chart, what it looks like, and I've overdrawn the pattern that I see. And there's 3 patterns, and this is the second one. And that's the actual chart. And the only thing I can't glean any of these moves like that, but the best I can do is I do see these patterns, and this point and this point predict the third point, and so on. So go ahead and look at video 1 if you want to see more about that. And in the second video, I also need to know where gold is going to. Because gold is, I'm not invested directly in gold, I'm invested in mining stocks, but the mining stocks perform as a multiple of the price of gold. So the pattern on gold is real clear to me, and I got the pattern on gold from just looking at the gold price. So there's no Dow involved in here. Just looking at the gold, I see that gold, stays at a price for a real long time, and this goes way back, and then it jumps up to a high. It did that in 1980, then it comes back down and hovers at some average value for a real long time, and then from that platform it jumps up to a new high, and it's a little more volatile now, but this is kind of where we are now or more recently, and it just kind of hovered around that number. And of course, this is kind of more or less the problem statement. And if you have one move and a second move, then you can extrapolate a third move mathematically. And that's what I did in the second video. So go back and look at the second video and see if you agree with that. And then on to the third video. This is a zoomed in view of the Dow Gold. And all I did was mathematically, I took point A, which is that date. It is this date right here, September, when all this started. And so I zoomed in on this little chunk of the, well, let's see. I zoomed in on this little chunk right here, and that is what this is. And so by doing that, I took a midpoint between here and here, and I said, well, when's that going to hit 1? Dow Gold equals 1, because watch the first two videos and even the third one, and I mentioned that a few times, that the Dow Gold always seems to return to 1, and of course, just that's where it's headed this third time right here. So that's where it's headed, unless it deviates from this well-established pattern. So, which it could, theoretically it could. I mean, things don't happen to happen exactly the way they did in the past, but this pattern is pretty, the odds of it not doing this seem to be really small to me. And so, again, I projected out dates. And of course, the longest date would be this one that goes through these two most recent points, and the midpoint of that and that. You get a slope, and you can figure out using math, algebra 1 or whatever. You can figure out what the date is, and I preferred this date. You could pick another one, but that seems the most reasonable to me, and that's the one I'm going to stick with for myself. I came up with a couple of other dates there that might interest someone else, but that seems the most conservative and most realistic, and it gives me an idea of how much patience I need to wait this thing out, stick with my positions that I'm already in, and so forth. So now we're to what this video is about. So that was the recap. And again, I'm just going to compare these investment vehicles with one another and see how they stack up. And going forward, I'm probably not going to need all that other data. I mean, after all, we're right here. And in fact, this video is just between those two dates. I'm looking at the performance because, a lot of this stuff, we are in January actually, and of 2020, but this is an end of month date on the macro trends chart. It's a monthly data chart, and at the end of the month, whatever that number is, that's what it stays at. And so in other words, this is still valid, even though it's January 23rd or 24th. It's on the weekend right now as I speak. I may update this in a few months and see if we're still on track. But here is the data. Like I said, I've already got the Dow and the gold data right here. It's just reprinted, and I had to go grab the Huey data. and this is an individual stock called Sabine, and this is Eldorado Gold. And so I'm comparing these, what's the performance between, it's a little over a year, about a year and 4 months, say, yeah, about a year and 4 months, from 9/28, which is the end of the month, and this just happens to be the middle of January. And it's about a week ago, actually. And so I did some calculations, and it's more than a year, so that's the absolute increase. And then when you normalize it to a year, here's your annual amounts. And so I'm going to focus on those numbers. Uh, I just normalized to 1 year, and so that's why the numbers are a little bit less than these, because this is a year and 4 months up here. But what I did what I did was I made up a couple of math problems with these numbers in them, and I'm hoping that well, let me just go through the math problems, and you can decide for yourself if they're of any benefit to you. I think they were of me. It just made me think about it a little more. Okay, so a bank CD gets you about 3%, and let's assume inflation's 2%. That's probably a little high right now as I speak, but I don't know because I don't buy bank CDs. I have bought them before, and it seems like I got them up near 3%, but I think they're a lot lower even now. So, but let's just assume 3% and 2%. And let's assume Jan gets 75%. That's a real number. That's right there. And these are all real numbers. From Carl gets, he buys into the Dow index and gets 7%. And so I just asked the question: how many years, months, and days must Jim and Carl invest to equal Jan's 1 year investment? And it's just simple math. You do have to subtract out if you subtract out the inflation rate, Jim ends up with 1%, and Jan ends up with 73 and 75. So the ratio of this to this, and I'm assuming, I'm neglecting compound interest that you might get on a CD, but so that number might be a little bit less, but it's ridiculous. You gotta, Jim would have to invest for 73 years, and who knows how, in order to equal Jan's 1 year investment. And the reason I did this, because I always get asked if I have cash in my account. Somebody's always asking me, don't you want that working for you? Don't you want it earning 3% or even 2% or whatever? No, I really want to focus on getting returns like this, and then just forget about it while it's if I don't come up with anything like this, then I don't want to sit there and fool with laddering CDs so that they come available every few months, and buying 10 years and 5 years and 3 month CDs. I just want to keep it in cash. Unless I'm earning, if I can earn something like that for 1 year, then it's equal to 73 years of fiddling with stuff. So why bother? And the other thing is I don't know that bank CDs are necessarily, as just because there's such a low interest rate doesn't necessarily mean that they're low risk. So that's the subject of another video. And, for Carl's case, he had a little bit better interest rate. So he had to fool around with investing for 14.4 years to equal Jan's 1 year investment. Uh, so again, some labor involved, I guess, with keeping up with all that. And like I said, CDs aren't necessarily risk free, and be a subject of another video. Here's a math problem number 2 question. This one's, I think, is really enlightening. I'll let you be the judge of that. Jan invested in Sabane's Stillwater stock symbol, SBGL, and got 245% return, and that really happened. That's a real number. It's not outrageous or anything. Bob invested in a Dow index fund at the same time when the stock market was 26,406. Again, I think I'm just using a real number right there, which is what it was on that date when this thing turned. Well, closed anyway. I'm jumping around here. It's what it was on 9/28. And oops, went too far. He invested at that rate. So how high must the stock market rise for Bob's return? He was invested here. How far must the stock market rise in order for him to get 245%? Well, there's the math right there. And the answer is 91,000 for the return to be as good. And, I think a lot of people seem to be excited about the possibility of the Dow hitting 30,000. It's trickling upward. To me, this puts everything in perspective. It's like, I guess my feeling is I don't really care. Because I don't even think that many people are invested in the stock market. I think a lot of it is stock buybacks. And when that thing starts crashing, I think the risk is really high. And look how high it has to go for you to get, the big return that you easily get, much easier, just by investing in some mining stocks that are just grossly undervalued, even grossly undervalued right there. There's some volatility involved. I mean, there's no volatility on getting a bank CD, but that could be a subject of another video, is the psychology of, overcoming volatility. Because if you hate volatility so much that you're willing to settle for 1%, then I think, at least for me, it's worth it to really try to overcome an aversion to volatility, and thinking that high volatility is the equivalent of high risk. And here's some conclusions I came to. The stock market is at or near all-time highs. I don't want to buy high and sell low. I want to buy low and sell high. So the mining stocks are at all-time lows. Are they at all-time lows because the individual companies are really, really bad and they're about to go bankrupt? Or is there a reason for it? So, it's not necessarily a great thing in other words, if there's a reason for the stock to be that low, such as the company being really bad, but I think it's because gold has just been at a real low, artificially low number. And I already talked about that. And if you want to, I'm going to try to be careful to say I and not you, because I'm not offering advice here. I'm just telling you what I did or what I think. And then if you find some use in that, and applying it to your situation, I would be real happy if that were the case, that you find something useful in this. And, if you have any questions, just put them in the comments. But let me read through this. Then mining stocks not only deliver a higher reward, but they deliver lower risk. And I believe that. And as I make these videos, I believe that more and more. So these videos are helping me become more comfortable with what I'm invested in. And I'm just saying here that the S&P 500, I use the Dow because the Dow has more historical data and this doesn't go back that far. But the S&P behaves the same way as the Dow in effect. And here's some future video ideas. I think maybe the next one should be something about risk versus reward and bank CDs. I don't know how to calculate how risky bank CDs are, but I saw a video and this guy was talking about it, and I was kind of surprised. It said bank CDs have some risk associated with it, and it might be pretty high. Even though you're getting such a low return, like 1% past inflation. So, these are future video ideas. And I'll just wrap it up there. And if you have any questions, just put them in the bottom in the comments. And thanks for watching, and have a great year.